Uh, Good morning and welcome to the third meeting in 2021 of the Finance and Constitution Committee. We have apologies this morning from Anna Sarwar. Today we'll take evidence from the Office of Budget Responsibility on its UK economic and fiscal outlook, and I'm pleased to say we're joined today by Richard Hughes, who's the chair of the Office of Budget Responsibility and the Budget Responsibility Committee, and Andy King, who's a fiscal expert with the OBR. I warmly welcome our witnesses to the meeting. And Richard, could I invite you to make a brief opening statement, please? Thank you.
Yes, thank you, Bruce, and it's a pleasure to be before this committee. My predecessor, Robert Choate, was a regular witness. I look forward to continuing our close engagement that we've had north of the border, both with yourselves as well as with the Scottish Fiscal Commission and of course with the Scottish Government. And I hope one day, once we've had all our jabs, to do so in person rather than virtually. As you mentioned, the EFO that we published back on the 25th of November was my first forecast as the new chair of the OBR. So perhaps I can just start out by giving the committee a sense of how events have unfolded relative to that forecast. And I should stress that what I say now is without prejudice to the official Scottish forecast that the SFC will be producing tomorrow alongside the government's budget. I'm sure we'll get into these issues around relative timing and timetables, which I know complicates both your work and the work of governments both sides of the border. But turning to how things have developed since our forecast, there was at the time of our November forecast, and there continues to be at the moment, an extraordinary degree of uncertainty, both about the economic as well as the fiscal outlook. And this uncertainty really originates from two sources. One is the path of the pandemic itself, which has very much conditioned all of our thinking since it started back in February, and to a diminishing but still significant extent, uncertainty about our trading relationship with the EU. And so for this reason, and reflecting that degree of uncertainty, our November EFO included three potential scenarios for the economic and fiscal outlook: an upside scenario, a central forecast, and a downside scenario for the economy and public finances. And that depended on the course of the virus itself, the effectiveness of public health interventions in containing its spread, and then the pace and the rollout, and the effectiveness of the vaccines, which at the time we were putting our forecast together in late November, had yet to be approved, and we were still awaiting the results of clinical trials. And so we presented alternative scenarios as well for the outcome of the Brexit negotiations, which at the time were also unknown. Of course, as it turned out, we got a deal on Christmas Eve, and so that avoided a downside risk to our forecast, which assumed that we were going to find and conclude a deal with the EU before the transition period ended on the 31st of December. So let me update the committee first on the pandemic and then briefly on Brexit. Concerning the path of the virus, the news since the 25th of November has clearly been largely negative for our economic prospects. The emergence of a more infectious and virulent strain of the virus has required the reimposition of a nationwide lockdown to keep R below 1. This is basically what we assumed in our downside scenario, which saw a further contraction of economic activity in the first quarter of 2021, rather than the resumption of a recovery which gathered pace over the course of the rest of the year. One bit of positive news that we have had in the near term is the fact that the economy only shrank by 2.5% in November, and that was compared with a much bigger fall assumed in November during the second lockdown. And this suggests that consumers and businesses are becoming better adapted to lockdown conditions and to operating under lockdown conditions than we thought. So that's a bit of positive news in the near term to outweigh the sort of largely negative news about the fact that we are back in a nationwide lockdown for the moment, and at least until the review point on the 15th of February. In levels terms, what that means is that economic activity was only about 8.5% below pre-pandemic levels during the second lockdown in November, and that compares to about a 20% fall in output that we saw during the first lockdown. So that gives you a sense of how much the economy is now able to adapt itself to lockdown conditions. Of course, there are some differences between the first and second lockdown. Schools were open during the second lockdown. They weren't back in April, but there certainly seems to be some strong suggestions that we are getting used to living under these kind of conditions economically. Looking ahead to the rest of 2021, the rollout of the vaccine is proceeding apace, and that's perhaps some upside news compared to our forecast, and provides some reason for hope that public health restrictions could be gradually eased as economic activity and allow economic activity to return to something close to our central scenario over the medium term. However, it stands to reason that with a new and more infectious strain of the virus in circulation, that the number of people one's going to have to inoculate before general public health restrictions can be lifted is also going to be higher. In our central scenario, we assume that this point was reached sometime in the second half of 2021, where you'd inoculated sufficient numbers of people that you could start lifting general public health restrictions. We're clearly going to have to revisit that assumption in light of discussions with the government's public health experts in the course of updating our forecast for the government's budget on the 3rd of March. Just turning to assumptions about Brexit, as I said, our November forecast assumed that the government would reach a trade agreement with the EU before the end of the transition period on the 31st of December. And such a deal was indeed concluded on Christmas Eve, which helped to avoid a further 2% fall in output that would have been associated with a no-deal Brexit under our forecast. So that was a downside risk that was avoided. We're going to be looking at the details of the agreement as part of our updated budget forecast and updating our estimates of its economic impact. But although I should say in the near term, there does appear to be more disruption at the border than we anticipated in our central forecast. Truck volumes at the narrow straits are down by about 30%. There's evidence that there are additional costs and frictions associated with trading with the EU, even beyond those that some had anticipated. And it remains to be seen how much of that is temporary and how much of that proves to be a permanent feature of our trading arrangements with the EU, and also how much of it is COVID related and to do with health checks at the border rather than necessarily linked to Brexit. Since the EU referendum, our forecasts have always have factored in for some time a long-run loss of output of about 4% associated with leaving the EU with a deal. And we're going to be reassessing that 4% estimate of the output loss associated with going from being an EU member state to leaving the EU with a free trade agreement. So far, independent experts, including the Governor of the Bank of England, have commented that they think that estimate is broadly right, having looked at the details of the deal. But again, we have to assess that both in light of what we've seen on the ground at the border in the last month or so, as well as the details of the agreement. And I should also mention that the deal largely covers trade in goods. It remains to be seen what kind of arrangements and agreements are come to regarding trade in services and future alignment of standards in the trade of services across the border. Those are matters which remain to be discussed. Let me stop there. We're going to be producing a fully updated economic and fiscal forecast alongside the government's budget on the 3rd of March, but hopefully that gives you a sense of where things stand as we see things at the moment.
Yeah, thanks, Richard. I'm sure that some of my colleagues, including myself, will want to seek a wee bit more clarity on your opening statement, but that was very helpful. As you say yourself, Richard, there are significant differences between the OBR's central forecast upside downside scenarios, both for the economy and for public finances. Just wonder, could you say a bit more about what the main factors you think will be that will end up affecting the path that we'll be on? And how could government policy and any fiscal stance at the budget play into this?
Sure. I mean, the single most important question is the pace of the rollout of the vaccine and how effective it is in reducing infections, fatalities, and transmission. And I think on that we're gathering evidence all the time. But ultimately, the rollout and the effectiveness of the vaccine dictates how quickly public health restrictions can be removed. So that is in the end the main driver of activity behind the forecast. I mean, in terms of what government policy can do and can do to mitigate the impact of lockdowns, and also I should say just general public concern about engaging in economic activity so long as the virus is abroad. It is certainly the case that support provided to businesses, the furlough scheme, government guaranteed loans have all enabled the economy to have sort of kept the economy alive and on life support during this period when economic activity is restricted. The government has extended that support periodically as lockdown restrictions and other public health restrictions have had to remain in place. They have no doubt avoided what would otherwise be deeper economic scarring both in the labour market as well as on the business side. So all of those measures do make a difference in terms of avoiding long-term unemployment, avoiding business failures that need not happen for businesses that are fundamentally viable. I think we'll have to wait and see as we approach the budget what happens with those schemes to the extent that they get extended even further to see what further impact they have. But it stands to reason that the longer that pandemic goes on for, the longer these restrictions remain in place, the longer economic activity is suppressed, there is a greater chance that you see a longer-term impact of structural unemployment in the labour market. You see more business failures and fewer businesses resuming operations as soon as the lockdown ends.
That's a very useful description of where we are, Richard. I just wanted to take you on to just a quick discussion about the interplay between the OBR and the SFC, particularly at this time. And obviously, the SFC forecast for the Scottish income tax will be published tomorrow, and they'll significantly inform the size of the Scottish Government's budget for 21-22, alongside the OBR's income tax forecast for November, which informs the adjustment to the block grant. Should you think we have any worries about these forecasts? You know, they'll now be a couple of months apart, given the levels of uncertainty and volatility that inevitably exist in the world that we inhabit today.
I think it's always been the case that we in the SFC have produced our forecasts at different times. I think it's a bit unusual for the SFC to be going first and us to be going second. I think that's probably not an ideal sequence, to be frank, but we're not in ideal circumstances. We've had a year of, as we documented in our economic forecast, sort of 14 different fiscal events south of the border. Since then, we've had one or two more in terms of major fiscal policy announcements outside the context of a fiscal event. I think that is the necessary artifact of the very difficult circumstances that we're in across the country and indeed around the world. In normal times, it would not be ideal for a subnational government to be producing its fiscal forecast before it gets an updated view of what the national picture looks like, because a lot of what the SFC uses as its inputs are our own forecasts. They will have the privilege of being able to take advantage of the latest economic data, as well as latest information about the course of the virus and the government's public health restrictions, which, as I mentioned, in the near term has been on balance negative. So they will update their forecast tomorrow. We will take that into account when we do our updated forecasts in March. But I think this sort of stutter step in putting forecasts together, I don't think is ideal in the way in which we conduct business. But I hope for the moment is just an artifact of the difficult times we're in.
Yeah, challenging. Finally, from me, before I turn to Murdo Fraser, obviously it's not entirely clear where we'll be when the next round of OBR forecasts are published at the beginning of March, and you've described that we're out of sync, and obviously there'll be concern about the level of risk to the Scottish budget from having the SFC and OBR forecasts at different times, given that uncertainty and volatility. I just wonder what discussions have been held with the Scottish Fiscal Commission and the OBR about these matters to try to ensure that the risk is mitigated to the greatest degree possible.
So we've worked quite closely with the SFC in the course of putting together our forecasts. I should say at the beginning of my tenure, Susan Rice and colleagues in the FSC were some of the first people I spoke to in talking about how we manage that relationship and that cooperation. I think there were two risks that we were concerned about at the beginning, which I should say have so far not largely materialized as concerns from the point of view of keeping our forecast consistent. I think one was that the differing compositions of the different sectoral compositions of our economies north and south of the border would mean you had a differential economic impact of the virus on Scotland versus the rest of the UK. And what we found, and as we reproduced in our devolved taxes forecast document, was that while there are differences, of course, in the sectoral composition of our economies, they're almost entirely offsetting. In terms of there are as many relatively benighted sectors as kind of blessed sectors in coronavirus terms north of the border as there are south of the border. Scotland has a few more. Down south we have a few more people working in sectors that were harder hit, but Scotland has other sectors north of the border which were less hard hit. So I think in that sense, as it turned out, the sort of balance between sectors that were harder hit by the pandemic and those that could survive the pandemic relatively untouched about evened out across the border. The other thing which concerned us was that you'd see relatively tighter restrictions either in Scotland or in England or in Wales, and so we'd have to take account of the fact that you had differential levels of restrictions in different parts of the economy. As it's turned out over the course of the pandemic, it's been more, things have sort of evened out. There were tighter restrictions in Scotland for some part of 2020, but then we had tighter restrictions in England for other parts. And in the end, the net result on economic activity, as I think you've shown in your own report in preparation for the 2021 budget, is that actually Scottish GDP and UK GDP have moved pretty closely together over the course of the pandemic. There have been a few differences in given months, but they've oscillated within a fairly narrow range of between sort of 1% and 2% difference in any given month. I think we'll await the SFC's verdict on whether they do indeed see a Scotland-specific shock based on the data that they're looking at. But I think so far what we've seen is actually much of the UK moving more or less in lockstep over the course of the pandemic.
Okay, thanks, Richard. Murdo, over to you.
Thank you, Convener. Good morning, Mr. Hughes. I thought my questions follow on really from that last point the Convener asked about, because I think a key interest of this committee is looking at differential impacts from the COVID-19 pandemic in Scotland compared to other parts of the UK, given that the fiscal framework, which determines the size of the Scottish Government's budget, is based on the relative performance of devolved tax revenues, principally non-savings, non-dividend income tax, relative to what's happening south of the border. So in that respect, how income tax is performing in Scotland is important, but insofar as it relates to what's happening elsewhere. So given that, is there anything you can tell us from your findings as to how do you think the Scottish economy and therefore by derivation tax revenues are likely to perform in Scotland any differently from what's happening elsewhere?
Yeah, I mean, so far we haven't seen big divergences in overall sort of gross value added or non-savings, non-dividend income on either side of the border. Whereas ever subject to what data we can collect in real time. And I should say, we'll await what the SFC say, who will look at these matters in more detail tomorrow. I think when what we do look at in doing our forecasts is what is the differential impact of the coronavirus shock on different sectors of the economy, because without understanding that, you can't really see the overall big picture impact for GDP. And it is clearly the case that for economies that have a larger share of hospitality, accommodation, tourism, those economies.
Just keep going. I think I'm just an interference coming in from the side there. I don't know what it was, Richard. Just back on.
Sorry. So clearly, economies that are more dependent on hospitality, accommodation, tourism, face-to-face interactions are much more vulnerable to the economic shocks associated with coronavirus. Whereas economies that rely more on financial services, professional services, and services that can be delivered at a distance are relatively insulated. What we found when we looked at the sectoral composition of Scotland versus the rest of the UK was that there were some sectors which made the rest of the UK look relatively favourable relative to Scotland. If you look at England, we've got more people working in professional services, more people working in IT, and that means that they are relatively more insulated to the coronavirus shock. But at the same time, Scotland has more people working in the health service and working in public services, and so that was a countervailing factor, which meant that Scotland was more insulated from the coronavirus shock, because most of those people are still working and still being paid, and that means that they are paying income tax. Once we looked at this on balance and tried to draw a sort of regression line through what you would expect to see in terms of the net overall impact on Scottish GDP versus UK GDP, we basically found a completely flat line. And that was what was reproduced in our devolved tax forecast, which is that there were offsetting changes in the sectoral compositions of the Scottish economy and the rest of the UK economy, which meant that on balance, you wouldn't expect to see a dramatically different tax take in Scotland versus England, purely based on the impact that coronavirus might have on our respective economies.
Okay, thanks very much. I'm afraid I had a connection issue there and lost for that, but I think I heard most of it. I just got one follow-up, if I may, and that's, I mean, it's been a very helpful and comprehensive answer, but I noticed in your report you do make reference to the fact that there were tighter lockdown restrictions in Scotland, Wales and Northern Ireland at some points compared to in England. I mean, do you think that's likely to have any impact at all on the economic situation and tax revenues, or really will it make no difference?
We don't think it's going to make a major difference, and for two reasons. One is that over the course of the year, different parts of the country have been locked down to differing extents. Wales obviously had a much stricter lockdown in the autumn, but then lifted their restrictions quite dramatically. And so we think that on balance over the course of the year, the sort of relative stringency of lockdown restrictions in different parts of the country have more or less evened out. But I think a second consideration, which is equally, if not more important, is just how adaptable our economies have proved to be to lockdown conditions. In that, as I mentioned, the fall in output that we saw in the first lockdown was nearly a quarter of total output in 1 month, of total activity in 1 month. What we saw during the second lockdown was a tiny fraction of that. Output was only down by about 8% in the second lockdown. So we are basically, the impact of lockdown on our economy is diminishing over time as we become more and more adaptable to operating under these circumstances. Now, there are obviously limits to that. You cannot, if you're in the restaurant business or if you're in the theatre business, it's very hard to provide services to your clients online in the kind of volumes and the kind of intensity that you would have done if these restrictions weren't there. But it does look as though in all parts of the country we are actually adapting ourselves to living in these conditions.
Andy, I see you wanted to have an hour in the chat bar. Do you want to come in? Thanks, Murdo. Andy?
Yeah, thanks. I just wanted to add the most timely information we have about tax receipts is not actually about the economy, it's about tax receipts themselves, which we can see in virtually real time. And they are telling the same story that Richard has there. So we see in the PAYE system, there's no obvious regional or national differences in the tax coming in. It's a similar story on the furlough scheme as well. The differences are small relative to the large movements overall.
Thank you, Andy. That was helpful and supplementary into the process. Patrick Harvey, please.
Thank you, Convener, and good morning to our witnesses. I think my committee colleagues know that I like asking questions about tax as well, but I'd like to go beyond just income tax and beyond the look back at tax information to see what's happening in the economy and think about tax policy going forward. And in this respect, my questions are on two levels really. One is about what may be likely to happen with reserved taxes and the ability or inability of the Scottish Government to do anything with its devolved powers, but also what the implications are with what I think we all already acknowledge is a fairly fragile fiscal framework, not as robust a piece of work as it should have been, if there are changes that hadn't been anticipated in reserved UK tax policy. Most of the ideas that I see talked about that might be under consideration are reserved either in the short term, things like a pandemic windfall tax on the companies that have done very well as a result of the pandemic, correction to the self-employment support, which has benefited some people whose self-employment income has actually gone up while leaving others excluded. I understand a correction to this could also raise significant revenue in the short term, and longer term ideas such as recouping at least some of the last decade's reduction in the corporation tax rate. These are all reserved measures, and they could have short-term or long-term roles to play, either in dealing with the immediate need or in future consolidation. So could the witnesses tell us what their perspective is on the tax policies that are going to be necessary, even if they may not be desirable to some going forward, either in responding to that immediate challenge or in fiscal consolidation or reinvestment in vital public services that are stretched to breaking point at the moment?
Sure. I think I should probably preface anything I say by pointing out that we're the government's official economic forecaster, and it's explicitly outside our remit, and we're prohibited from giving the government advice on fiscal policy, be that tax policy or spending policy. I think what we can say, which I think speaks to your point in macroeconomic terms, is that in our central forecast, at the end of the medium-term forecast period, in 5 years' time, after we hope the effects of the pandemic have largely abated and worked their way through the economy and public finances, the government is still left with a significant deficit, and one that is about 4% of GDP, and is well north of any definition that either the Chancellor has expressed or economists have in their own minds about the definition of fiscal sustainability or balancing the books. There was about £40 billion worth of deficit reduction that needed to be found at the end of the forecast period in our EFO before the government took the policy measures that it did on the spending side to try and reduce them. They cut about £10 billion off spending in the last spending review, which reduced the level of spending and reduced that £40 billion gap by £10 billion. That still leaves about £30 billion that would need to be found in fiscal consolidation of some sort to deal with the structural hole left in the public finances relative to the most generous definition that one might have of fiscal balance by the end of the forecast, which would be to balance current revenues against current spending, but allow some amount of borrowing for investment. It's also, roughly speaking, the amount of deficit reduction you need in order to stabilize the debt to GDP ratio, which is featured in previous government fiscal frameworks and is also one definition of debt sustainability. So there is, based on our forecast and based on some conventional definitions of sustainability and balance, some fiscal consolidation needed over the medium term. I guess I have to say how the government decides to do that, whether they do it on the tax side or whether they do it on the spending side, and what measures they use, we would have to leave as a matter for the government, and it wouldn't be for us to comment on how they do it.
I entirely appreciate that it's not your place to recommend one policy or another, but it surely is part of your role to discuss and to consider the implications of one choice or another. For example, there does seem to be some discussion, both at the UK level and internationally, about the corporation tax option. Some discussion that I've seen about whether there would be agreement among OECD countries to establish a minimum floor for corporation tax, so that, for example, the big transnationals can start paying their share without, jumping from one tax jurisdiction to another and managing to get out of that. Do you see the prospect that can play a significant role in the short term, or is it entirely a longer term consideration? And is the OBR in a position to consider what the implications are for the Scottish fiscal framework if, we've already seen that it's not well designed for unexpected events. That may be inevitable, but if we continue to see these decisions about what's the balance between tax policy and spending policy made at UK level, where does that leave Scotland's ability to make any decisions at all, or even to satisfy what now look like fairly petty considerations, like Scotland should raise a comparable amount of money to what it spends?
Yeah. I suppose so far, I guess let me say two things on that point. One is that the kind of sort of fiscal gap that's left at the end of our forecast as a consequence of the coronavirus shock is around 1% of GDP. That is a very big hole to try and fill just with corporation tax, if that's what the government were to try and do. It is of the sort of magnitude that you have. If government wanted to fill it with tax alone, it may well want to visit some of the larger tax heads and not just corporation tax, which is not only something which raises much less revenue than things like income tax, national insurance, and VAT, but also is something which is much more sensitive to decisions about international investors, where corporations locate, and therefore much more subject to avoidance and evasion if rates change than other taxes. Capital is just naturally more fleet of foot than labour or
in the absence of international cooperation. But if there's the prospect of more international cooperation, that effect could be balanced.
That's true. I think you're still left with the challenge of it just doesn't raise as much tax as VAT, national insurance, or income tax does, and you've got a decent hole to fill by the end of the forecast if what you want to do is either balance the current budget or stabilise debt, and so it may require something more comprehensive. I think the other thing to say is that so far the government's revealed preference is to continue cutting spending rather than raise taxes as a way of improving the medium-term fiscal position. The only real consolidation measure we've seen so far out of this government since the start of the pandemic was a £10 billion cut to non-COVID spending, which they haven't actually said where they're going to find, beyond saying part of it came out of the ODA budget and part of it came from a reduction in grants to local authorities. We don't know where the rest of it is going to come from, but for the purposes of our forecast, it provides £10 billion worth of deficit reduction in every year of the forecast out to the end of the forecast period. So, but like you, we await what the government's actual policy package looks like in this budget, as well as in future budgets.
Thank you, Convener.
Thank you, Patrick. Alistair Allen, please.
Thank you, Convener, and thank you, Mr. Hughes. I'm going to turn to the other big factor which you've acknowledged is affecting both the UK and Scottish economies, and that is the impacts of Brexit, but particularly the Brexit deal, because as a committee, as most other people, most of the material that we're dealing with to analyse that question is written pre-deal. So I wonder if I can press you for any views on how you feel the deal itself and what's in the deal is likely to affect the Scottish economy. There's been obviously a great deal of focus on certain sectors that are affected by the deal, some of them important to many people in Scotland, like fishing, but more broadly, can you say anything about the impact of the deal on the Scottish economy and our economic situation going forward?
So, as I mentioned, in what our forecast has assumed since the referendum has been that the UK concluded a free trade agreement or a trading agreement with the EU, which is broadly in line with the average sort of free trade agreement that advanced countries have concluded with institutions like the EU. And based on what we've seen so far, and I should say we're still going through the details of it at the moment, it looks broadly in line with what we've assumed in our forecast, the sort of long-term loss of output of around 4% relative to being an EU member state. And that is related to the fact that there's now grist in the mill. There are costs at the border from trading with the EU, not in the form of tariffs, but in the form of paperwork, and in the form of delays, and in the form of compliance with things like phytosanitary regulations. And all those things act as deterrents to trade, both in the near term and over the medium term, and have consequences for things like investment and productivity, etc. I think what we didn't assume in our forecasts, but other forecasters did, was some near-term disruption to economic activity associated with getting from our previous arrangement to the new agreement. We had assumed that, given that both the UK and the EU had negotiated this deal, there would be forbearance on both sides about its implementation. It would appear that for the moment, a lot of these checks are actually being applied, especially on the European side of the border, and relatively stringently. And I think also there is a degree of the degree of business preparedness for the new trading arrangements has been less than we might have anticipated. There appear to be fewer companies on the European side that might have registered with HMRC for VAT, which means that they're adding VAT on top of prices to goods when they arrive in the UK, and these are reflected in some of the news stories that you see. Businesses do also appear to be not applying the rules of origin, but instead just applying customs tariffs for goods that may have originated outside the EU, and those things have also added to the cost of goods as they arrive in the UK. And then finally, we've just seen, and you can see it in sort of daily lorry volumes, that there is just reduced trading volumes across the border over the last month or so, sort of down by 20 or 30%. How much of that is temporary and is only going to last for the next few months, while businesses on both the UK and the EU side become more familiar with these arrangements and overcome the sort of one-off costs of adjusting their systems and getting to know how to fill out these forms? We're not yet sure. We're going to look at it as part of our forecast, and how much that proves to be permanent is an issue that needs to be we need to look at in more detail. But I think one thing to stress is that there is still quite a bit of uncertainty about other aspects of our trade with the EU. About goods covers about half of our trade with the EU, but the other half is services. And there is at the moment a process of negotiation around a memorandum of understanding on trade and services under negotiation between the UK and the EU at the moment. We don't know where that's going to end up. There's a deadline of the end of March to come to some kind of agreement, and that will continue to be a source of uncertainty around our outlook for the services trade.
You mentioned earlier on some of the differences between Scotland and the rest of the UK. They perhaps weren't huge, but there were differences in terms of the emphasis that there might be in terms of the impact of COVID. Can you also see any differences in terms of the Scottish and UK economies that might account for a different response or impact from the situation you've just described around the Brexit deal?
No, I mean, possibly. I mean, they're not enormous. The biggest differences between the sectoral composition of Scotland and the rest of the UK are really in the areas of information technology, professional services, healthcare, most of which are largely unaffected by the trade deal as it's being arrived at, or kind of cross-border frictions. These are either largely non-tradable services provided to our own population, or their services which are kind of out with the deal itself. There are some small differences in the proportions of agricultural output and fishing, but in terms of overall GVA and what really matters for Scottish GDP and the tax take, they're not very large. But I think we should also. I think we'll await the more detailed assessment of the Scottish Fiscal Commission when they come out tomorrow. But I think from looking at the sort of sectoral vulnerability of Scotland versus the rest of the UK from a Brexit lens, those differences don't seem to be material to me. But what I would say is that the sectors that are affected by Brexit are different from the ones affected by coronavirus, right? I mean, coronavirus affects basically non-tradable services provided to your own population. Brexit affects tradable goods traded across the border to other people's populations, and so their impacts are additive. But based on what we've seen about the relative shares of those vulnerable sectors between Scotland and the UK, they don't appear to mean that there'll be much of a material difference in their impact on either side of the border.
Well, perhaps my question is prompted by representing a constituency where fishing is a major industry, and where the 50-page form is something that people tell me about on a regular basis. But I suppose that doesn't take away from the truth of what you say. But what I was going to ask you about really was there has been a concern expressed in many quarters that the impact in the longer term, or the medium term, and the longer term from Brexit and the Brexit deal and the fallout therefrom might be as big as, over the next few years, the impact of COVID. And I just wondered if you had any take on that, or any view on that as it applied to either the UK or Scotland.
And based on our own forecast and what we've factored into our own projections, the impact of leaving the EU and going from being a member state to trading on the kind of terms which it would appear we're going to be trading under this deal is a long-term reduction in output of around 4%. Where the impact in our central forecast, the impact of coronavirus on our economy in the long run, the sort of long-run scarring effect is about 3%. So Whether you conclude that those are roughly in the same ballpark, or one is bigger than the other, I think is a matter of your perspective. But they're both significant long-run shocks to the UK economy with long-term consequences. But I should say there is a lot of uncertainty about both of those estimates. If for coronavirus, we provided a range of scenarios. One where you have a highly effective vaccine, which allows the economy to quickly get back to normal this year, and perhaps you wouldn't see any scarring at all. Whereas if you have vaccines which are less effective, especially in reducing transmission across the population and reducing hospitalization and mortality, you could see the need for social distancing rules still in place over a period of years, and that would have a much more serious effect on labour markets and on businesses, and you could see much more scarring than we've got in our forecast.
And finally, Convener, Mr. Harvey was asking you about the decisions that may need to be made in the future or that the UK governments may feel the need to make in the future to cope with some of the longer-term consequences you've just described. Now, while I appreciate you pointed out that these are decisions for you to make, do you have any view about the urgency with which, or the timing with which some of these decisions that the UK government may feel the need to make them? Obviously, the options being around cutting public spending, which is many of us would question the wisdom of doing in the middle of a situation of this kind, or putting up taxes. You've said you don't want to take a view, quite understandably, on which of those should happen, but can you say anything more about the likelihood or the urgency of decisions having to be made, the timing of decisions having to be made?
I suppose maybe I could say two things, and obviously these decisions are all for the government, and including the timing of them are all for the government. I mean, one thing I would say is that at least up until now, what we've seen is the government continuing to loosen fiscal policy, or at least spend more money from one fiscal event to the next, because they're dealing with a pandemic and with an economic shock which is ongoing. And so I think up until the November forecast, and we've seen further instances of this since then, the government is still in sort of rescue mode rather than thinking about what it needs to do to consolidate the public finances, with the important exception of the £10 billion worth of non-COVID spending, which they have taken out of their medium-term spending plan. So I think there is a small down payment on that longer-term consolidation that has been made, albeit rather quietly, at the time of the spending review. But on top of that, the government is continuing to do things like extend the CGRS, extend further support to businesses during lockdown. So I think for the moment the government is in counter-cyclical fiscal policy mode, rather than thinking seriously about consolidation, and when it comes to do so is a matter for them. I think one thing which alleviates pressure on governments around the world to do anything about their fiscal positions at the moment is the fact that government borrowing costs are just extraordinarily low. There is essentially no pressure from markets to do anything about their deficits or their debt levels at the moment, and the signal that markets are giving governments is that they are happy to lend them the money that they need to pay for the support that they are providing to employment, to businesses, to get us through the pandemic. So I don't think that there are no signs of near-term pressures from financial markets for governments to do something about their fiscal positions, which has traditionally been one of the things which has put pressure on governments to act quickly, and sometimes more quickly than they would have chosen, either economically or politically, to address the kind of deficits that we've seen in the wake of the pandemic.
Thanks, Alistair. Dean Lockhart, please.
Thanks very much, Convener, and good morning to our panel. Thanks very much for joining us. My question is a follow-up to the discussion we've just heard about in terms of financing the UK government debt, because in recent years the Bank of England has played an increasingly important role in financing the UK government spending, especially the exceptional levels of spending on the COVID response. So I wonder if the panel could briefly explain the role of the Bank of England in helping finance the UK government's response to COVID, and whether this gives the UK government some more flexibility in terms of when it might have to look at fiscal measures to address the deficit.
Sure. And I think you're right that quantitative easing by the Bank of England and also by central banks around the world, I think, has provided some indirect support to governments in raising the finance they need in order to fund the very large spending programs that they have had to introduce in the wake of the pandemic in the face of falling revenues. I think it's important to stress that that support has been indirect and through the secondary debt markets rather than direct. I mean, this is not the sort of monetary financing, money printing that you see in countries like Venezuela and Zimbabwe, where the government just goes to the central bank and asks them to lend them some cash directly. This intervention is happening through the gilt markets. The government is issuing large amounts of debt in order to finance its very large deficit at the moment, and the Bank of England is then intervening in the secondary market and buying some of that up from the primary purchasers. The effect of that, the net effect of that has been twofold. One is that, well, threefold. One is that it's helped to ensure the continued smooth functioning of the gilt market, which I think is important to everybody, to the government, to the economy. This is a sort of national asset, and keeping it liquid, having the Bank of England there as a backstop to ensure functionality is something which is very valuable to the UK, as it would be to any economy in any country. Another effect of it, however, is the fact that because the Bank of England finances its purchase of government debt by creating its own central bank reserve, so its own liabilities in the form of central bank reserves. These have a much lower interest rate than the debt that they're buying up. They're buying up long-term government debt of a 10, 15, 20, 30-year maturity with a higher interest rate, and they're financing that by issuing their own liabilities of central bank reserves, which have a much lower interest rate, but also they have a maturity which is effectively overnight, so a much shorter maturity. So the net effect on the public finances is twofold. One is that it reduces the government's overall debt servicing costs because higher interest longer-term debt is replaced by lower interest short-term debt, which is and goes from being a liability of the Treasury to a liability of the Bank of England. But the other net effect is that it dramatically shortens the maturity, the overall net maturity of the public sector's debt, because you've replaced this higher rate, longer maturity Treasury debt with lower rate, shorter maturity Bank of England debt. And what that does is leave the public sector more exposed over time to changes in interest rates. If bank rate has to go up in order to fight inflation or just normalize interest rates back to more historic levels, that will suddenly and more dramatically and more immediately hit the government's borrowing costs, because Bank of England liabilities, interest rates can change overnight. Unlike government gilts, where if they have a maturity of 10, 15 years, it takes time for the outstanding liabilities to be extinguished and replaced by new ones. So it's much cheaper for governments to borrow now, thanks to the help of the Bank of England, but it also means that the government is much more vulnerable to any decision that the bank might have to make to raise interest rates in the future, because that would immediately raise its own interest rates, which are increasingly in the form of central bank reserve.
Richard, thank you very much. That was a very insightful response and very interesting. I guess it just stresses the important role that the Bank of England is playing in all of this. I wondered, very briefly, I'll come on to another issue, but very briefly, in terms of the budget deficit, are you able to comment on the expected level of the UK budget deficit in this current year, or is that something you have to keep in reserve for later?
I think it's one of the big bits of news coming out of our 3rd of March forecast. So I think we'll have to keep it back until then. And I should say we're only at the early phases of our forecast process, so it would be too early even to provide a kind of early comment.
Yeah, understood. I wanted to move on to another issue you touched on earlier about the different sectoral components of the economy in Scotland, and the fact the public sector in Scotland is larger as a percentage of the economy compared to other parts of the UK. By and large, public sector employees have not been furloughed at 80% of salary, but have continued to be paid at normal salary levels. I wonder, will this particular dynamic have a positive relative impact on Scottish income tax receipts versus the rest of the UK, where the private sector is larger and therefore proportionally a higher number of people have been furloughed at 80%?
I wonder if I might bring in Andy on this, who's been looking at the RTI information in more detail than I.
Yeah, sure. This comes back to the discussion Richard had with your colleagues earlier, in that while the public sector is a source of cushioning the blow in Scotland, you have other sectors, particularly IT professional services, that are a source cushioning the blow in other parts of the UK, and these things really net off. And we're seeing that in the sectoral GDP data, we're seeing it in the real-time information from the PAYE system. And so at the whole economy level, whether that whole economy is Scotland or the rest of the UK, these things are netting off. One interesting thing that surprised me over the course of the year is that the proportion of employers that furloughed at 80% rather than furloughing at 100% and paying the top up themselves was lower than I expected. So more employers continue to pay full pay and then just reclaim what the government was offering.
Okay, thank you very much. And Convener, I just have a very brief follow-up final question. In its relation to, Richard, you said earlier that you potentially might be looking at a 5-year period before the economy fully recovers from COVID. I wonder if that's baked into the official numbers the OBR is working on, or is that perhaps just your personal reflection of how long the economy will take to recover?
I think that was more in relation to just the horizon that we look at in doing our forecasts. I think one benchmark that we use in trying to think about where the economy gets to at different points is just to think about when does the level of economic activity get back to where it was pre-pandemic. And as I mentioned, we set out 3 different scenarios back in November for the course of the pandemic, and public health restrictions. In our most optimistic scenario, the economy was back to its pre-pandemic level by the end of this year, by the end of 2021. In our central forecast, which is the one which underpins and will be the comparison for the SFC's forecast, it wasn't until the end of 2022 that the economy had recovered to its pre-pandemic level of activity, and that assumed a rollout of the vaccine, which reached about half the population by the middle of this year. Perhaps the government's a bit ahead of that timetable, perhaps it's a bit behind. A lot of it depends on the interaction between the rates of inoculation and how much you actually need, given the more infectious strain of the virus. But on our central forecast, that crossover point where we reach pre-pandemic levels of activity was reached at the end of 2022. In our downside scenario, where basically vaccines are ineffective in reducing infection and fatalities, either because they prove less effective in the field than they did in clinical trials, or because you see mutations and variants that are vaccine resistant, you don't reach that crossover period until the end of 2024. So it does very much depend on how effective the vaccine is in allowing economic activity to normalize. But based on our central forecast and based on what we knew on the 25th of November, we had that crossover point at the end of next year, so the end of 2022.
Okay, thank you very much for those answers. And Convener, I'll hand back to you.
Thank you very much, Dean. In that case, can we go to John Mason, please?
Thanks so much, Convener. You've already talked about balancing the public finances and that the government's not in that mode at the moment. Can I just ask you on that then, does that impact on the recovery? I mean, if the government did try and balance the finances sooner rather than later, does that mean growth is reduced, or is it not as simple as that?
It is as simple as that in some ways. We have a fiscal multiplier that we apply to fiscal policy, which takes account of its impact of fiscal policy on the economy. This obviously the dramatic loosening of fiscal policy that you've seen since March has supported economic activity and meant that as bad as the recession that we have faced over the course of the last year has been, it would have been a lot worse had fiscal policy not provided support to consumption, to business activity. And so in that sense, fiscal policy really does matter for growth and for the economic outlook. Were the government to decide to focus on deficit reduction, raise taxes, cut spending in the near term, that would have consequences for economic activity. through its multiplier effect on incomes, on consumption, on investment. How the government does it, however, matters. We don't apply a single multiplier to all tax and all spending. The composition of spending really matters. Were the government to cut investment, that has a much bigger multiplier effect than cuts to government spending or to cuts to benefits. So the composition of the adjustment matters as much as the timing for its economic effects. But all fiscal decisions have economic consequences because ultimately they're taking money out of the pockets of people who would otherwise have it as income and have it there to spend.
Yes, and that was my second point, really. I mean, taking money out of the pockets of people is done by tax, but I mean, it could also be done by savings. That there's been some reports that people are saving more, presumably because of the uncertainty. And presumably that, well, therefore they're spending less, and that's not feeding through the economy. Is that significant? Does that have a big impact?
It's certainly that the savings levels have been very significant. We've seen savings rates in this country which are higher than that we've seen in decades, and probably higher than have ever been seen since savings rates were recorded. Savings rates went up very high into double digits during lockdown. People were either still working full time or being supported by the furlough scheme and not able to consume, and so they built up large bank balances. We saw some of that unwind at the end of the first lockdown, when people who had delayed either social consumption, going out to restaurants, or they had delayed purchases of consumer durables, went out and purchased those things. And so you saw some of that pent-up savings feeding into a surge in demand, and actually a faster recovery of the economy after the first lockdown than we had initially anticipated. And some of that was people using up the savings that they had built up. You may well see some of that as restrictions are eased over the course of this year, and a sort of savings-fueled sort of mini consumption boom over the course of the year. I think it's three things, however, need to be counted against that. One is the fact that these savings are being built up largely by wealthier households who have been able to work and able to work more or less full time during lockdown. And these people have a lower marginal propensity to consume. They tend to save more anyway, and so they will be less inclined to spend the savings balances that they have built up. A second thing to bear in mind is that sort of everybody is scarred by this experience, and people may well want to hold on to a higher level of precautionary savings over the longer term, because suddenly more people have experienced periods of worklessness. There's uncertainty about the future course of the pandemic. We don't know what further shocks might come down the road, so people might want to hang on to a higher level of savings in future than they have in the past. And then the third thing to say is that sort of an economic recovery which is fueled by running down your savings is not fundamentally sustainable, right? It's something which can boost the economy for a few years, but once you've run down your savings back to the level of savings that you want to have for precautionary purposes, you sort of run out of fuel. Traditionally, what you look for sustained recoveries is recoveries in investment, because that actually supports the long-term productive potential of the economy. And what we haven't seen, really since the middle of the last decade, has been a significant recovery in business investment, and significant strength in business investment growth. It was hit initially by the referendum. It was hit again by the pandemic. And so what you want to see for a sustained recovery is not just a sort of surge in consumption coming off the back of some temporary savings, but actually a recovery in businesses and households investing.
Okay, I appreciate that. That's very helpful. Thank you. And my final area I wanted to ask you about was...
John, can you hold a sec? I think Andy wanted in with some further comment. Right, I see he's put an R in the chat bar. So Andy, am I right there?
Yes, if that's okay. There were just two things I thought I might add. One on your first question, the withdrawal of the very large fiscal support. You can see in the three scenarios that we presented in November that the withdrawal of, if you just think of the furlough scheme as the biggest, the timing at which that closed was commensurate with our assumptions about the public health restrictions on the economy in the upside scenario. And there was very little rise in unemployment in that scenario. But it switched off before we assumed public health restrictions would switch off in the central scenario, and that led to spike in unemployment. And in the downside scenario, those things were very much out of kilter, and unemployment spiked to a very high level. So you can see in the way we've tried to do the figuring that lining these things up is important for what we see as the economic outcomes. The other point I was just going to add on savings is you're seeing all around the country house prices rising very quickly at the moment, which I suspect is more down to people finding a home, quote unquote, for their excess savings rather than actually just being driven by the temporary tax holidays.
Okay, that's also very helpful. I appreciate that. Thanks very much. And my final point was just, you make the point in November in the report that UK output had fallen the sharpest contraction on record and one of the largest among advanced economies. I just wondered if that had changed over the last couple of months compared to Germany, France, other countries like that.
We'll have to see. It was the case that the UK experienced quite a sharp contraction in economic activity. Given that we are now back in nationwide lockdown and are experiencing some of the highest case numbers around the world, I wouldn't, if you think that there is an arithmetic relationship between cases, lockdowns, and economic activity, I suspect that we are going to continue to suffer some of the bigger economic consequences of the pandemic compared to the rest of the world. We'll have to see, including in light of what international organizations produce in terms of comparative GDP numbers. It was the case that, based on what the numbers we saw in November, that we appeared to face a bigger economic hit than other countries. That was partly because we locked down later than other countries, which meant that we had to lock down longer in order to get case numbers down to levels which allowed the reopening that happened over the summer. We've also now had a much bigger second wave than at least you've seen so far in other European countries. So obviously we're all looking at the same numbers with the same degree of trepidation. That would suggest that we are continuing to face a much tougher economic consequence of the pandemic than other countries. There are some measurement issues around GDP which have gotten a certain amount of coverage in the financial press and attention from Parliament in Westminster, who had an inquiry on this. We do measure GDP a bit differently from some other European countries, in particular the fact that we close schools and the fact that there's been some diversion of activity in the health service we pick up in GDP, because we measure the output of the education sector and the health sector in activity terms rather than in spending terms. So in the UK, if teachers are getting paid but they're not teaching, the fact that they're not teaching gets reflected in lower GDP. In other countries, if they close their schools but they pay their teachers, that doesn't affect GDP because they count education GDP just as spending out the door, as salaries paid, not as lessons delivered. That makes a little bit of a difference in international comparisons between us and Europe. It doesn't really explain the still very big gap between our economic performance in 2020 compared to a lot of other countries on the continent.
Thanks, Convener.
Thank you very much, John. Tom Arthur, please.
Thank you, Convener, and good morning. I wonder, Richard, if you could comment on how your anticipated forecasts around borrowing have developed over the past couple of months in light of developments with the new strain of the virus and a second lockdown.
Yeah, I might see if Andy wants to comment on this as somebody who looks at the fiscal numbers closely.
Yeah, sure. I guess the first thing to say is that the key point is the one that you made at the start, that the virus and the health restrictions look a lot more like our downside scenario than our central right now. But the data point we have on the public finances since our last forecast was, I guess, more positive or less negative, depending on how you think about it, than we had assumed, which carried on a pattern and is consistent with the fact that the November GDP didn't fall as sharply as we thought. So the starting point, if anything, might be just a touch less negative, both in economic and fiscal terms. But 1 month of data in the middle of a very dramatic swings through a pandemic is one would be unwise to place too much weight on anything, I think.
And maybe if I could just add one point to make, is that the other thing to bear in mind is that most of the increase in borrowing that we've seen over the course of the last year was discretionary fiscal loosening. This was the government spending more in order to deal with the consequences of the pandemic, unlike previous economic shocks we faced where the borrowing effect has been the fact that you've had a smaller economy and shrinking tax receipts. And so one of the risks to the borrowing outlook is always the fact that if things turn out worse on the economy side, the government ends up having to spend a lot more to cushion the economy if it keeps extending the furlough scheme, keeps extending business loans, keeps extending tax reliefs. And the government has been making those decisions kind of month to month. And so our forecasts for spending over the course of 2021-22 are based on the government's current policies, but don't build in any anticipated reaction to what's going on at the moment in terms of lockdown lasting longer, restrictions potentially being in place for longer, and the additional support that might be needed to support the economy in light of that.
Thank you. Just continuing on that theme, I noted in the earlier comments, Richard, you highlighted the signals from the market right there that they're content with current levels of borrowing, and there's no sort of near to medium term signals that that's going to change. One thing I'd like to bring up specifically, though, with regard to that is within the economic and fiscal outlook at paragraph 1.39 in the executive summary, it makes reference to increased vulnerability of the public finances to future shocks. Is that, and I'll just continue there for a matter of clarity and for the benefit of the official report, in particular to a sharp increase in short-term interest rates. Is that just a contingency? Because it was another point that you made in which you suggested that in an extreme downside scenario, and I think if I'm quoting you correctly, social distancing rules could be in place over a period of years. So clearly we hope that's not going to be the case, but if such an eventuality were to unfold, is there general confidence that the levels of debt and indeed borrowing could be sustained to maintain the existing measures that are in place, or would we reach a point where something had to give?
I guess I'd say two things on that. One is that this is a global shock, or at least it's a shock that's affecting most advanced economies, not equally, but certainly severely. And so I think so to that extent, because it's a coordinated shock, so long as the same things are happening to all advanced economies, the financial markets who are looking to invest in advanced economy debt don't view the UK as different from any other country, and its economic and fiscal prospects dramatically differently. And so in that sense, what we're seeing is a global reaction to the pandemic and a sort of global flight to safety. Were the UK to start having a different experience of the pandemic from other economies, we may have to worry about interest rates rising or sort of financial market effects that are UK specific, and investors looking at UK gilts as an investment relative to US treasuries or Japanese government bonds and saying and deciding whether they like the outlook for the UK economy relative to these other countries. At the moment, there's a coordinated global shock, and so everybody is more or less in the same boat. But that's not to say that we might not end up having different experiences of the pandemic from here on in. In terms of our vulnerability to interest rate changes, I mean, this is an artifact of the interaction between quantitative easing and the government's borrowing program, which is that QE is essentially refinancing the government's debt from long-term to short-term. It's buying up long-term debt and replacing it with short-term debt. And so whatever happens to interest rates, we are more exposed to interest rate changes in any given year. And just to give you a sense of magnitude, before the financial crisis, when you took account of both Bank of England liabilities as well as Treasury liabilities outstanding in public hands, the average maturity, the share of our debt that had a maturity of less than 1 year was about a quarter. Since the financial crisis and since the pandemic, when QE has really picked up in earnest, the share of our debt which has a maturity of less than 1 year is now about a half. And that means that of any change in interest rates that you see, about half of it you would get in the space of 12 months. You would feel in the space of 12 months on the public finances. And so in that sense, at the moment, interest rates are extraordinarily low and they've been falling. So we've seen a huge and rapid benefit of those falling interest rates because we've been refinancing our debt at such short maturities, at shorter and shorter maturities. If that starts to go in the other direction, if interest rates start to rise, we'll start feeling the opposite consequence of that, which is that interest rate changes are going to feed through to our debt interest costs much more quickly because we've got more and more of our debt with a maturity of less than 1 year. And so it's just that much more sensitive to whatever the prevailing market interest rate is.
Thank you. And if I could ask one final question, were a differential to emerge between countries in terms of the efficacy of their public health responses to COVID, how long do you think that would take to feed through into decisions taken by the market?
I think that I'd hate to hazard a guess about how markets actually look at countries' differential pandemic performance. I think that lies somewhere between financial market experts, economists, and public health experts, I'm afraid. And
if it was something that would feed into the OBR's considerations as we progress through this year, if a differential does emerge, for example, if the UK is outperforming the rest of the world and we have strict restrictions in place around international travel, or the converse, if we saw a significant spreading of the virus within the Eurozone, within the United States emerging later in the year, we had a different scenario within the UK. But just to get a sense of how you would anticipate that the lag, if there was one, between that becoming concrete and evident and affecting market behaviour. But if you feel that's not an appropriate question to answer,
I think it's one where I'd be loath to hazard a guess.
No, but I appreciate it. Thank you very much. No further questions, Convener.
Thanks, Tom. Fulton McGregor, please.
Thanks, Convener, and good morning, panel. I wanted to ask a question which picks up on your earlier response to Murdo Fraser. We've received data suggesting that total earnings of employees subject to PAYE in Scotland fell by 1.4% between April and October relative to the same period in 2019. Can I firstly ask, has there been any change in that since October, with the further restrictions that have obviously been put in place? And can I ask what might be the implications of this for Scotland's income tax revenue?
Andy, do you want to have a go at that one?
Well, I don't have more up-to-date data in my possession than you have. The data that we used from the real-time information system in November, as we've discussed before, showed very similar performance in Scotland to the UK as a whole. Indeed, when we were doing the same job for the Welsh Government, showed similar performance in those areas. I think we come back to the same point that it seems that the shock has been equally painful to our, to the respective economies and respective tax bases, and that's the basis on which we have been producing our forecasts. The latest UK-wide data on average earnings growth coming from the PAYE system shows negative. So there's been a drop in the number of employees on payrolls, but there's been quite a sharp increase in the average pay of those who remain on payrolls, part of which is to do with all the support that has been thrown into the economy, part of which is to do with the shock hitting hardest at the bottom of the earnings distribution. So the lost jobs or the lack of job creation has been among those with below average wages, which pushes up the average of everyone who's left. You can see that in the Office for National Statistics measures as well, where I think they said, roughly speaking, pay growth is running at 4%, but it would be 2% if you didn't have this change in the composition. But as to what it means for Scottish income tax revenue, and particularly what it means for Scottish income tax revenue relative to the rest of the economy, we're still of the view, but we'll need to look again for March, that the shock is symmetric to all intents and purposes.
Okay, thanks for that. I mean, earlier there was a comment about Scotland's particular workforce. There have been more people in the health service and public services generally, something that's quite well known. Do you think there's any inherent advantage in that? Not necessarily in comparison with other UK countries, just in terms of Scotland. Is there any positives that can be taken from that as we try to bounce back, from COVID? That there is a lot of people in the public sector, and particularly the health service, given that we're in the midst of a health crisis and responding to that.
I think there probably is a need for some reflection on how much investment countries around the world have made, both in their public health systems, but also just in spare capacity in the health service. I mean, going into the pandemic, we had one of the lowest numbers of hospital beds, ICU places, diagnostic equipment per capita of any health services in the OECD. And a lot of the extra spending which the government has done since the pandemic has been to very rapidly expand that capacity. And I think one of the issues about the sort of fiscal legacy of this crisis, I think, will be a set of decisions around what kind of standing level of capacity you need in your health service to deal with surges in demand, either from pandemics or from other sources, and what is going to be the longer term legacy of healthcare needs of those who recover from the virus. And so I think it is a big question. It's a big question for our forecast. It's a big question for the government when it makes its fiscal policy decisions about whether how close to the limit of capacity should you run a health service in normal times in order to be able to anticipate the surges in demand that you face at times like this.
Thanks, Convener.
Thanks, Fulton. Now, I'm conscious that we're getting closer to 10:30 and that Andy will need to leave us just before 10:30. With that being said, can I just check if Jackie Bailey or Alexander still want to ask a question at this stage, or are they content with where we are? Jackie, can I ask you first?
Yeah, thank you, Convener. I will run all my questions together if that helps. I've got just a couple, but they only require brief answers. Can I just say I don't envy you your jobs. The uncertainty in forecasting at the moment is a real challenge, so thank you very much for sharing your knowledge with us. Firstly, you talked about the adaptability of the economy, and I'm keen to understand more about that, because I think we will face restrictions for many more months to come. So you talked about 25% drop in GDP in the first lockdown, 8% in the second. Are the numbers similar in Scotland? Because there is a concern about a differential impact here. You seem to suggest as well that borrowing is very affordable now, and that will smooth the recovery from COVID. But what I didn't hear, which is obviously more difficult for you to tell me, is over what timescale you think that kind of honeymoon period with borrowing is likely to last. And the final thing, Convener, UK spending envelopes obviously have a consequence for our Barnett formula. If the UK government, and I don't know what they're doing, are they providing additional funding across all public services, or are they likely to target services like the NHS? And if they do so, that will have a knock-on effect potentially for other public services that could mean cuts. And that will do for me, Convener. Thank you.
Thanks, Jackie.
Let me take the adaptability and the borrowing cost question, and then I might ask Andy to come in on the third about the composition of spending and what it means for Barnett consequentials. I think on adaptability, I think what we've seen is a process of increasing adaptation over the course of the pandemic. It started in construction and manufacturing, which and obviously from the very beginning there were sectors which almost continued as normal from the beginning. People who work in professional services, economic forecasters like ourselves, didn't find it all that hard to continue our work online, and we've all gotten used to Zoom and Teams and Blue Jeans and all these different ways of interacting. And so, in that sense, people working in the services sector have found it who don't provide face-to-face services to clients have found it relatively easy to adapt to working during the pandemic. Manufacturing needed to do some adaptation of their workplaces to make them COVID secure, but we saw a pretty strong recovery in manufacturing output over the course of the pandemic, even during lockdowns. Construction similarly. The sectors that are continuing to really struggle are hospitality, accommodation, entertainment, and transport, which is now obviously also now affected by any restrictions that might be introduced on travel. And it's in those sectors that you haven't seen level of activity recover very much relative to where they were in April when you go back into lockdown. So there are clearly limits to the adaptability of the economy. And I think a big question is, looking at the adaptability within sectors, whether you start to see over time adjustment across sectors. Does capital, does labour start to move from sectors of the economy which can't operate at 100% capacity into those sectors of the economy which can actually operate above 100% capacity in the course of lockdowns? And those kind of structural adjustment issues start to come into the frame if it looks as though, as you say, some form of social distancing or public health restrictions need to be in place over the longer term. And what governments can do to facilitate that adjustment, how many employees get lost along the way and end up inactive or permanently unemployed, is a very big question for policy as well as for forecasting. In terms of how long is the honeymoon going to last, in terms of low interest rates for governments, this is partly a phenomenon of the pandemic, but it is also actually something which has been going on for decades. Equilibrium interest rates for government borrowing have been really falling since the 1970s. And this is an artifact of a whole range of factors. The fact that we've basically whipped inflation and inflation expectations are now permanently low. People believe that independent central banks and inflation targeting is effective in keeping inflation under control, and that reduces inflation risk and keeps borrowing costs low. It's also an artifact of the fact that there is a large supply of global savings, both from the sort of demographic bulge of people who are still contributing to pensions in advanced economies and not yet drawing them down in retirement, but also a large and growing volume of savings in Asian countries for people who there are saving, to buy property and for their own retirements. And so in that sense, there is a large supply of savings looking for safe investments and looking for diverse safe investments, not just where the savers are, but in assets around the world. That could also continue to support very favourable borrowing conditions for governments for some time to come, but is again a sort of ultimately a temporary phenomenon. These people are going to retire. They're going to want to enjoy their retirements. They're going to want to draw down on their savings, and so at some point, all those beneficial forces might go the other way. So it's I think it's too soon to say that the honeymoon is going to be over anytime soon. But some of the factors that have reduced interest rates are permanent, so long as monetary policy credibility remains. But some of the factors are temporary, like the fact that for the moment we're seeing a large supply of savings around the world. But that might not be the case in this.
And Andy?
Yeah, in terms of the composition of spending, the COVID response, it is unsurprisingly concentrated in health services. So on the Treasury's numbers, you're talking just over 50 billion of the 114 billion that they describe as COVID departmental spending has gone on health. The other big numbers are transport, but a lot is being held in reserve just to deal with things as they come. And then next year's numbers, roughly half is health and roughly half is in reserve and therefore unallocated, and those allocations will presumably be made over time. And in terms of the pressures beyond that, I think, as Richard said, there's a lot of interesting questions about the degree of spare capacity you want to hold in different services. There's open and difficult question about how railways are funded and operated, and social care has been an issue on the to-do list of governments for many, many years. So there are a lot of questions still open. I should take this opportunity to say I do apologise for having to run now, but it's fun doing this job in a pandemic, but not with 2 very small children at home and 2 full-time jobs. So I will miss the final question. Apologies.
No problem. Thank you, Andy, for your contribution, though, while you're still here. Obviously, everyone's got childcare responsibilities, or many people in these circumstances, but your contribution was valuable, so thank you very much. And Jackie, provided you follow up, I'm going to go to Alexander Burnett.
Thank you very much, Convener, and I completely understand why Andy has to drop out. This question was probably more directed for him, but I'm sure Richard will be able to answer another question after that. You mentioned the composition of components and people not being able to consume. Andy maybe countered that with saying that house prices were rising. I should note my register of interest in around construction at this point. And you've also got the real-time tax receipts. If you had to pick a component of your composition of components that we should be focusing on to encourage your forecasts, which one would that be?
Do you mean in terms of what has the biggest, bang for buck in terms of fiscal policy?
Yes. Yeah.
I think it's when you look at what we call the multipliers that we use for government spending. So where do you get the most bang for your buck in output terms from government intervention in the economy? By far the biggest multiplier you get is from public investment, and part of that is because it gets spent on non-tradable goods in the economy rather than leaking outside. Partly because it gets spent directly rather than if you give money to households. They save part of it and they spend part of it, and they don't spend it immediately. They may end up spending it over the longer term. And so in that sense, you get the biggest multiplier effects from public investment. I think the challenge perennially for governments is the fact that while you get the biggest bang for your buck out of public investment, it also takes the longest to organise and get going, because especially if you're spending it on infrastructure schemes, there's a large amount of planning that goes into these sorts of things, procurement processes, land purchases and these sorts of things. So there is a trade-off between sort of the bang that you get for the money that you're spending and the time and the speed at which you can have that effect on the economy.
Okay, thank you. And my final question, I suppose, given that, and I suppose we are seeing healthy activity from people buying houses, house prices rising, and maybe the private sector, dare I say it, doing their share of lifting the economy by making those investment decisions. Coming sort of full circle to what you opened with, your forecast, your scenarios were back in 25th of November. A lot's changed since then. I don't envy you in that regard. The Brexit figures seem to have been correct and factored in. You say that people are working better than expected in the conditions. Both these factors and the one around maybe construction and manufacturing would imply some positivity. The IMF have maybe slightly upgraded or improved their take on the UK's figures for this year and slightly upgraded it for 2022 with the caveat of your differences in GDP measurement. Of the 3 scenarios, would you be erring towards the upper scenario or positive in that regard?
I think all of this remains to be seen, I should say. I think in the near term, because of the fact that we've had this more infectious strain of the virus that we're coping with here in the UK, and because we've had to reintroduce a national lockdown, in the near term, I'd say that economic conditions are closer to our downside scenario. But the pace of the vaccine rollout, which is really the longer run determinant of the level of economic activity than anything that happens in the nearer term, is unfolding more or less in line with, if not a little bit ahead of, what we were assuming in our forecast back in November. And that is clearly a good piece of news about the medium term and offers us some hope to get back something closer to our central forecast over the medium term. I think the big risk for that, however, are the variants of the virus that have emerged, and in particular, variants that are either more deadly or more transmissible, pose challenges for how quickly you can then release public health restrictions depending on the pace of the rollout of the vaccine. Because obviously, if these variants are more infectious, you need to vaccinate a larger proportion of the population before you can be confident that you've reduced levels of transmissibility below the levels that allow economic activity to start to normalize. So we're going to have to look at the balance between the more infectious strain of the viruses against a potentially faster pace for the vaccine rollout than we anticipated to see. When do you reach that crossover point where government feels confident to lift what restrictions at what point over the course of the medium term? I think looking at it at this stage, I think it's too early to say over the medium term whether we're in the upside, central, or downside scenario. And clearly, if more variants emerge or the variants that are out there look to be either more infectious or more virulent than we thought, then that would be bad news for what we're assuming about how much economic activity we're going to be able to engage in beyond the current lockdown.
Thank you very much. No further questions.
Thanks, Alexander. And can I warmly thank both Richard and Andy for your extremely helpful and very interesting contributions today. That was the only item on our agenda for today's business, so I therefore now close this meeting of the Finance and Constitution Committee and thank everybody for their involvement.
Thank you.